In a recent article on CNBC.com, our next guest writes that the S&P 500 is increasingly dominated by tech and therefore questions whether it's still the best benchmark for investors. Kari Firestone is executive chairman and co-founder of Aureus Asset Management, as well as a CNBC contributor. What I want to really ask you about, I mean, benchmarks are nice, but you got to decide whether you want to be long the market and go all in or whether you maybe aren't as aggressive. So I kind of wanted to talk macro. You can talk about why you think maybe there's other ways to play it, but that's just assuming that you want to play it and that you're long. Here's what my point is. 2023 was much better than people thought. I think 2024, given the backdrop with the Fed and inflation and, real near-term worries about how we handle this, I think you need to really, I think the risks have increased. Beginning of 2023, no one was bullish. Everybody hated it, but it was a great year.
We were bullish.
Yeah, you were bullish. Is it the same? Is it going to repeat in 2024, or are there some significant headwinds like $34 trillion in debt and stubborn inflation? Maybe no rate cuts. Is this a time you want to be in the market?
Yes. So I think you do want to be in the market.
You always want to be.
It's the degree to which you want to be in the market. And in fact, we're up 9% roughly so far this year. The market's up 26% since the end of October. So the market has moved forward despite really the hawks about interest rates. They've been right. If you listen to someone like Roger Ferguson, he's the person who said, no cuts now, no cuts. That's been correct, but the market has continued to power higher because earnings have been good. Okay. Now, I agree. There are risks. There are more risks this year than last year, 100%. But that doesn't mean you can't have a decent market, and we're having a decent market. The question is whether the market is the same as what we used to call the market. What's really powered this market are 4 or 5 names. It's not the whole market. They talk about how good earnings are. The earnings for the big tech names are up about 40% in the first quarter, and the rest of the market is negative a couple of percent. And that's going to be true throughout the year. The estimates keep going up for the tech names, and estimates are not going up for the rest of the market. So you have to be careful what you think of as the market.
So the S&P 500 is more like the NASDAQ used to be?
Correct. 43% is in tech, communication services, and Amazon. That's 43% of the market. And I've looked at this for years because I find it fascinating. I used to say, I still say, Apple and Microsoft, the 2 top names, are 14% of the market, 13.5% of the market. The bottom 300 names in the S&P 500, the same size. And that was not true. If you look back in history, the 2 top names would be, 6%, 7%.
Does that make you nervous?
Yeah.
Just the tech itself?
It makes me nervous that we are so exposed. It's not that it doesn't represent the market. Of course, the S&P 500, it's true. It's identified as the biggest public companies that are profitable in the United States. And so what you buy is truly those companies. However, those companies are more concentrated and those industry sectors are more concentrated. Maybe everybody doesn't want that much exposure. I'm not talking about what we discuss as the S&P. I'm saying people in their 401k, when investors in our business make these choices.
9% is more than the average stock return in a year.
Correct. Yes, so 7%.
So we already have 9.
We already have 9. So if you wanted to be cautious and sell, I understand that. But, for most people, if they've owned the big tech names, they have gains. They have big gains. Do they really want to take those capital gains?
Yes, if you think the capital gains rates are going to go up next year.
Yeah, and if you're Stan Druckenmiller and you're looking at your gains from NVIDIA, yes. If you're Warren Buffett and you're looking at the gains from Apple, yes.
Yes, because those guys, they think about the whole big picture, and they're in the market actively. Yeah. But most people who get out don't necessarily get back in. The average mutual fund does much better than its average investor because the fund continues and the investor sells at the wrong time and buys at the wrong time.
Well, we might not get any help from the Fed, and inflation might stay sticky. And 9% is above the long-term average anyway, but then the wild card is AI. Maybe we get another, I don't know how many points of percentage gain, because AI is transformative. So maybe that gives it to us.
Of course, but as we know, NVIDIA is the only one who's really making any money in AI. Everybody else is spending money on AI. If you looked at what is the biggest change from what we expected in the first quarter, it is how many billions, tens of billions of dollars the big companies are spending on AI. You know, 40 billion here this year, 50 billion here. It's really unbelievable, the size of those numbers when you think about those tens of billions that are just in capital spending on AI technology and research. What I also think is fascinating right now is that if you were to say, let's invest some money in an equal-weighted S&P, index, equal-weighted S&P 500, and the tech names were to come down 10%, 20% to take some risk off the table, you can have lots of companies that can start to perform better than...
It might be a different way of looking at it. We tried to ask Buffett this question over the weekend. He didn't exactly answer it. But, he's long been a proponent of the S&P 500. The question is, would you look at a different way of measuring that doesn't take tech so much into account?
What's good for
you leave gains on the table when tech takes off.
Correct. Yeah. But Warren Buffett has the only stock in the top 10 that is basically, financial insurance. I mean, he has been able to command a spot there because of how well he's run his business, but also because of technology, because of Apple, more than anything else.